My name's Paul Arakelian. I'm a licensed insurance agent in the state of California, in Nevada, and in New Jersey. I'm also licensed for securities. I had a company called California General Insurance and Financial Services. So today I want to kind of go into the stereotypes that have been brought to us as a community, as a people, by certain people that have gained quite a momentum in their careers, and they do have an impact on the layman, because we don't understand a lot about life insurance. We just know it's insurance, it protects your family in case of death. But they end up, saying you need to buy term life insurance. The whole life insurance is the hole that you fall into, or permanent life insurance is unnecessary to own. My first question to these guys, whether it would be people you hear on radio, people you hear on TV, on very reputable channels, MSNBC or CNN. My first question to them is, if you're a financial advisor and you're helping your clients build a certain amount of estate, obviously your mindset is to have them earn as much as they can, have them have the highest yields and all their portfolios and all their investments. So essentially you're building them capital. Now this capital is going to be taxable to be transferred to the next generation. You're advising them to just own term life insurance. You can only own term life insurance up to a certain age. And if you're getting term life insurance when you're age 75 or 73 or so, it's literally going to cost you a significant portion of your gross estate. And you might not be able to afford that. Now, if the life insurance is not there, somebody's got to pay Uncle Sam. The estate taxes have to be paid regardless. And so it may be your property is going to be sealed from going to probate because you have your living trust done. Beautiful. That's not going to save you from not paying taxes. Your taxes have to be paid. Now, your next generation, your children, may have to sell some properties, may have to liquidate other assets that you might own to pay for it. Or you can have spent throughout your lifetime cents on a dollar to own permanent life insurance and have that pay for your taxes, and not have to liquidate your assets or a portion of your assets to pay for, and it adds up to about 45 to 55%, and if you got a term life insurance policy as you've been advised by your accountant, which you should not be advised by your accountant to buy life insurance, same way as you shouldn't be advised by your grocery store owner about your heart condition. Same holds true for not being advised by your accountant to own a certain type of life insurance policy. Talk to them about your taxes, but not about your life insurance. Or you've got so and so on TV appearing regularly. They have a book written, they're famous, and they're saying, oh, just buy term life insurance. They may either tap into your senses, so you listen to everything they say. Every word that comes out of their mouth is true. And so you end up making decisions not based on logic, asking yourself a question: what if I outlive a term life insurance policy? A term life insurance policy is not going to be worth the paper it's written on if you outlive it. Term life insurance policy is a great way to insure your temporary needs, i.e. mortgage, growing children. They can be on autopilot at the age of 20, 25, you hope, right? Out of your nickel, and you can satisfy that need spending the least amount of money out of your pocket. But if you were to do a real logical calculation of what a term life insurance policy costs you, just take all the premium dollars, maybe $16, $17 a month, as you see a lot of advertising about that. Now internet.coms are selling term life insurance, saying a healthy 45-year-old male can get $250,000 of life insurance for less than $17 a month. It doesn't say it's only a 10-year term. So you get excited about it, go on, sign in and buy life insurance. 10 years pass by, you're still healthy, around, and your life insurance policy is gone. Now you get a bill that's huge compared to what you were paying, the $16, $17. So the point is, you can do the calculation. Let's say you're getting a 30-year term policy, not a 10-year term. 30 years is at least a little longer time. There is a lot more that you're going to accomplish in 30-year period, a time frame of your life. 30 years is a significant portion of your life. So you've raised your kids, put them through college, paid off your mortgage. But at the end, just do a calculation. If you had $1 million life insurance policy and you were paying $84 a month, for example, 84 times 12 is going to be $1,008. Now you take that $1,008 multiplied by 30, that's going to be $30,240 at the end of 30 years. So that's what you've spent on your life insurance policy. And you think that, oh, well, $84 is not really making me poor, giving me the peace of mind that I can't buy, that peace of mind spending $84 anywhere else. And here's this wonderful thing. Now let's consider you having spent $30,240 over a 30-year period. Not a big deal. I mean, for the peace of mind that you got having $1 million life insurance policy, it's a wonderful thing. But you're all about building capital. You just bought a home and it cost you about 2.5 times of the original loan to pay it off. But you have a home, it's paid off. And, now you've got your life insurance policy that you've paid $30,240 for over a 30-year period. Now that $30,240 is gone. You really couldn't get a tax deduction on that unless your corporation or your company was buying the insurance for you. That's a whole different setup. You've lost the $30,240. The lost opportunity cost on that $30,240, if you were just calculating the money being invested at 4% over a 30-year period, that's going to be significant. That's going to be over $50,000. You would have made about $50,000 had you invested that money, that $84 every month for that 30-year period. Now you've also lost your $1 million life insurance, right? That $1 million was probably the only place where your kids would get $1 million income tax free payable to them. Now I said income tax free. I'm not saying estate tax free. Income tax free. That's the only $1 million income tax free that will be passed to your next generation. Now it's not there to be passed anymore. Insurance company keeps the money. So you haven't just lost the premiums. You've lost the premium plus the lost opportunity cost on that, and you've also lost the death benefit. Now don't think of it as a horrible title, a death benefit. Think of it as capital. $1 million is $1 million regardless of the title, whether it's a death benefit or living benefit or what it is. It's money that was due to be paid to your next generation, to people that are carrying the same last name as you. That money's gone. So you haven't just lost the premiums. So the next time you're listening to an advisor on TV or on radio or has a book out or something talking about term life insurance is building you the most amount of capital, or it's the best way to go, just think about it. Make a decision based not on your senses but on your logic.